Good evening. My name is Philip Lee, and welcome to the second session of Become a Millionaire. This has been such an exciting group for me. I've been getting so much good feedback, and the fact that everyone is coming back for session two is really, it really gets my juices flowing, and it's making me up my game because I don't want to disappoint you all. So this session I'm very excited about because after today, you will learn how to begin investing, assuming you're not an experienced investor. If you ought to be investing already. So without further ado, we're going to start with a poem that's written by Robert Frost, but I have a very special treat. This is also read by Robert Frost. So here we go. So just the rules, original material copyrighted cannot be used without my consent, and disclaimer, information advice is true to the best of my knowledge, and you have to use your own risk, okay? Do your own homework and make your own decisions. Don't want to get sued for my teaching. So here's the agenda for today. I have 7 sections. The first section is really to really just spend a couple minutes reviewing session 1 and talking about the homework. And then the second part is really about the way I'm going to teach this course in terms of, am I teaching for the long term or am I teaching for the short term? And I'm going to talk a little bit about that because that's a little bit of a dilemma that I've had to work on as I've created the material for this course. And then I'm going to describe what it takes to climb this ladder to success. What does it mean? And what do you have to do to do that? And then we'll get into the meat of today's presentation, which is the Expand Wealth by 5% module. So I'm going to go into a lot of depth about what compound growth means. It's a very powerful concept, and it's one that you have to really internalize in order to fully appreciate what we're teaching here. And then the second part is talking about how do you get annual returns. And I call this investing baby steps. So I'm going to take you by the hand. It's like a little baby when they're walking for the first time, holding onto furniture, maybe falling. It's all okay because this is the baby steps of investing. And then I'm going to talk about how annual savings, along with compound growth and annual return and annual savings together, really create this engine of wealth that you will learn to use in the next few months to a few years, and that will be something that you could use for the rest of your life to great advantage. And then we're going to talk about the cut expense 5% module. So that will help you create some funds to put into your Become a Millionaire account, and then to make it grow. And then we'll review the curriculum for the rest of the year, and then we'll talk a little bit about this session. So let's talk about session 1. I'm sure you've all seen this chart now. And these are what I call the rungs of the ladder that you have to climb in order to get to be a millionaire, which is level 9. I'd ask you all to figure out what level you're at now. Are you at 1, 2, or 3? But whatever level you are, that's okay. If you're at level 3, for instance, it just means there's 6 rungs of the ladder you have to climb before you become a millionaire. So that's a good long-term goal to get to level 9. But what I want you to focus on for the next few weeks to few months is really just the next level above where you are. So if you're at level 3, focus on level 4. So let's say you have $31,000, focus on $63,000. So create a short-term goal that's within sight to really be more motivating for you going forward. So whatever level you're at, look at the next higher level and set that as your next immediate target. And we talked about how fast can you go. So these are the what I call the ACE chart, which is augment income, cut expense, expand wealth. And the question is, how quickly can you learn to move up these 3 strategies and to be at least intermediate or advanced in all 3 of them. And the faster you move up this chart, the more quickly you will become a millionaire. So that's really the point of this. So the homework that we had was, you had to estimate your current level. You had to figure out what your BAM Composite score is, your current BAM Composite score, and then generate your initial net worth forecast, which you don't have to do because I'm going to share with you one of the tools that I've developed to help you do that. You should have a list of ideas for augmenting your income, and you should have a list of expenses that you have. So at this point, you haven't cut anything yet, but you've started to brainstorm and come up with these lists. And then in terms of expand wealth, hopefully you've opened the brokerage account, you've named the account, and today we will begin to show you exactly how to invest your money for the next 10 weeks. So that's where we're at. So this is the tool that I'm telling you about. It's called my net worth forecast tool. It's actually a spreadsheet that's in the Become a Millionaire folder that I'm going to tell you about in a minute. But the blue cells are the ones that you fill in, John Doe, the date you filled it out, your date of birth, what your current annual income is, your BAM Composite score, for this person is 5%. And this chart will automatically generate just by filling in those blue squares. And what it will show you is that, at least for John Doe, it will take him 37 years to become a millionaire. So it's just an example, but all you have to do is fill in the blue cells, and the whole spreadsheet will calculate by itself, okay? So this is the Become a Millionaire folder. What you need to do is, when you go in the meetup, just send me a message with your email address on it, and then I will put you into the Google group, and I'll make sure you have access to this folder. You can see it's a Google Drive called Become a Millionaire folder. And at this time, I've got 3 folders in there. Now, if you click on BAM session number 2, you click on that one, you will see this. You will see the contents of that folder. So the contents includes 88 ETFs that I'm going to talk about later, includes the BAM worksheet for session 2, includes the Become a Millionaire workbook, the ETF selection worksheet, the ladder to success, and the net worth forecast tool. So that's when you would use to fill in those blue cells and then create your net worth forecast, okay? So that's where we're there. And I think most of you know this, but I've launched a Become a Millionaire YouTube site. The link is in the meetup site, and I will post all my future sessions on the site so that if you have to miss the session for whatever reason, or if you want to do a quick review, it's there for you, and you can either look at certain parts of it or you can look at the whole thing. So that's up and running.
On YouTube?
Excuse me? Did someone say something? Okay, so as you guys probably know by now, I'm using the first Tuesday of every month to do these sessions. So I've dubbed first Tuesday of every month Become a Millionaire Night. So mark your calendars. For the rest of the year, my plan is to do every monthly session on the first Tuesday of every month. So let's talk a little about long-term versus short-term. So it was a little bit of a dilemma for me as to what to do. And what I opted to do was what I call a blended approach. So when I talk about long-term, it's generally a more theoretical solution. And I'm talking about something that may take a long time to learn all the basics about. But at the same time, I want to make sure that I provide you ideas and concepts that you can use immediately. So that's where the short term comes in. And these ideas are very practical. So as an example, on the augment income strategy, I have two long-term classes that I'm going to teach. One is to become CEO of your job, and the other is to become CEO of your career. So those were the two topics in the book that I wrote. So I've taken those ideas and I've put it into one of the later sessions, but that takes a long time to be expert those two things. And I don't think we'll wait that long to see results. So while I'm doing those two things, I'm also doing some short-term and practical things for augment income. One is to create the list of opportunities that you should have done already about how you can augment your income. I'm going to talk about how raises work. You probably don't know sort of the how the sausage is made, but I will explain to you what managers do, whether they have to get approval and how all of that works. And that will help you immediately. And I'll also talk to you about what's the best way to speak to your manager in a way that's effective. So those are short-term things that support the long-term goal, but can provide you some immediate results. If we look at cut expense, one really good way of cutting expenses is to buy a home. You convert your rent into your mortgage, and you start to build equity. Your home appreciates. It's a wonderful way to cut expense and build some equity. But that takes a long time. It may take you a year or 2 years to buy a home. And how about learning the tax code? If you know the tax code a little bit better, you may be able to reduce your taxes, but that also takes a long time. So for the short term, I'm going to have you create a list of expenses, and we're going to find opportunities to reduce your expense immediately. So both long-term and short-term combined for a blended approach. When I'm talking about expanding wealth or investing in the stock market, people spend years, decades studying different ways of approaching the stock market. Some of the things people talk about are they study fundamentals. Fundamentals would be like a company's revenue and what market are they serving, what's their market share, what's their earnings. These are the fundamental facts about a company that help you understand whether they're worth investing in. And people spend years studying fundamentals. Other people look at technical charts. They look at what's called candlesticks, and they look for patterns in the technical trading charts, and they study that for years to understand when's it good to buy, when's it good to sell, when is it overbought, when's it oversold. And that's also a very long-term thing that people do, and I'm going to work on that a little bit, but that takes a long time. And there's literally hundreds of different investing strategies available. You can invest long, you can invest short, you can sell options, you can buy options, you can do. There's many investing strategies out there. And again, that takes a long time. what I'm going to do today is I'm going to provide you a very simple approach to get you started. And it will support the long-term goals, but it will also get you going immediately. So the time frame for the long-term approach really is, could be many, many years. So that's a long time. And we don't have that much time to teach this stuff. It's almost like going to college. You go to college for 4 years, and then after you graduate, then you get your first job, right? You don't get paid a nickel until you finish 4 years of college. That's what long-term and theoretical is like. What I'm going to do in addition to some of the long-term stuff is I'm going to focus on learn by doing, on the job training, just things that will help you immediately, but also be supportive of the longer-term vision. So that's what I'm going to do. So let's talk a little bit about this ladder to success. What does it mean? What does it mean when Phil says, I'm X% on a certain strategy? So just as an example, what does it mean to say that you achieve 5% in expanded wealth? What does that mean? It's actually a 4-step process to achieve that. So first, you have to listen to the presentation, and that for the 5% expand wealth will happen today. It's happening right now, actually. And then after you hear it, you've got to review it. You have to make sure you understand all the concepts being presented. And then you have to achieve 5% annual return once. That's step 3. And step 4 is you have to do it consistently. So before you can say you've achieved 5% in expand wealth, you have to have achieved all 4 steps. Steps 1 and 2 are really about you're learning the material, you're understanding material, making sure that it all makes sense. Steps 3 and 4 is about performing, it's doing the work, and it's achieving consistently the results that you're looking for. So you all know that there are 3 ACE strategies now, and I'm just going to assume everyone starts at 0% on all 3 strategies. And each strategy has 5 achievement levels, right? So if you're at 0%, you have to, it's one level to get to 5, then another level to get to 10, then to 15, 20, and 25. So 3 strategies, 5 levels each. So there's 15 levels to be achieved. And within each level, you have to do all 4 steps. So that's a lot of work. So I've actually created a worksheet to help you keep track of where you are. So you've got to augment in the first 4 columns, cut in the second 4 columns, and expand on the third 4 columns. And step 1 is what we're doing today for expand on the 5%. So after you print this out, after you get access to the Become a Millionaire folder, you print the sheet out, you can put today's date, which is 2/2/21, in 1 because you will have accomplished step 1. And I'm also going to do the cut 5% today too, so you can fill that in. And then I'm going to assume it'll take you a week to figure out this, what I'm teaching you in terms of expanding wealth. So you put 2/9 there. And then let's say it only takes a few days for you to get the cut expense. You put 2/5, February 5th there. And then, unfortunately, it's going to take a year for you to show 5%. So maybe on January 1st, 2022, you can have achieved it once, and then at January 2022, you will have achieved the 5% for the year. So that's how this chart works. So your goal is to put a date in every single cell in this worksheet, okay? So let's move on to the meat of the presentation, which is about expanding wealth 5%. So before I get into the details of it, I want to spend a little bit of time on the stock market because that's really the basis of what we're doing here. So if you're an experienced investor, and I know some people are, just bear with me as I bring the beginners along. I think this will be a good refresher for you anyway. So here we go. First thing that you have to know is that there are no guarantees when you invest money. So it's not a sure thing. It's like there's no guarantees that of anything in life. So this is just like that. And in order to become a millionaire, you need to take some risk. So I think every millionaire that exists on this planet has taken some risk at some point in time. So you got to be willing to take some risk. And what I'm going to help you do is, even though you have risk, I'm going to do things to help you minimize that risk. So that's the key. It's not to eliminate risk. That's impossible. But you can have strategies that make sure the risk is as low as possible while still having the benefits of the stock market, okay? Investing is about the long term, okay? It's about the future. When you invest in something, you're betting that that company or whatever it is that you're investing in will go up in the future, and you have to have some foresight into the future in order to do this. Another thing that you have to believe, and I believe, is that in the long run, the stock market is going to go up. You have to believe that. If you don't believe that, this doesn't work. So, I mean, if you don't believe that, you cannot invest in the stock market because you're basically unable to look into the future and see things, stocks getting more valuable. Excuse me. Next thing you need to know is, if you're investing for the long run, there will be ups and there will be downs in the stock market. You just cannot panic when it goes down. And believe me, I've been there. I mean, I know what it feels like when the market drops, 5, 10, 15, 20, 25%. It's scary. It's real money and you're losing it. But if history teaches us anything, is that in the long run, it comes back and you really have to just hang in there. And the first time it's hard, the next time it's not so hard. So over time, you I wouldn't say you get used to it, but you get accustomed to sort of the rhythm of the stock market. And when you buy a stock, when you buy any type of security, you really should be planning to hold it for a long term. So what I teach is not day trading where you buy, sell the same day. I'm not teaching you to try to play the swing, just to get some short-term fluctuation. There are people who do that and they do it very successfully. I'm not knocking it, but that's not what I teach. I teach long-term investing and holding for a longer period of time. Okay, so that's what I teach. So there are approximately 7,000 stocks that you can buy. On the either the New York Stock Exchange or the NASDAQ, and about half those companies are based in the US. This was as of January 2020. If you add up the value of those 7,000 companies, they represent about $80 trillion worth of value or wealth worldwide. The two major stock market exchanges in the US are the New York Stock Exchange and the NASDAQ exchange. And each stock has a price and has a number of outstanding shares. So the market cap or the value of a company is really the price of that stock multiplied by the number of shares outstanding. So I did this on January 26th. Apple's symbol is AAPL. On January 26th, the price of Apple was $142 a share, and there were about 16 billion shares outstanding. So Apple, at least as of January 26th, was worth about $2.4 trillion. So that's a lot of money. Here are the 14 most valuable companies in the world. So, Roche Holding is a pharmaceutical company. They're a big drug company based in Switzerland, and they're worth actually $2.5 trillion. And they're growing their revenues about 5% a year. Apple is worth $2.4 trillion, and they're growing about 3% a year. Microsoft is obviously a large software company. Amazon is in e-commerce. Google, Alphabet is Google, which is a tech company. Tesla's a car company. Facebook, social media. Alibaba is like Google in China. Taiwan Semiconductor, builds semiconductor chips. Berkshire Hathaway is what's his name? I can't remember saying. He's a very famous guy. Oh, Warren Buffett. That's Warren Buffett's company, and it's a conglomerate. They've got all sorts of businesses in Berkshire Hathaway, and they're worth $548 billion. and they're growing about 10% a year. Johnson & Johnson's a pharmaceutical company, growing 2% a year. Visa is a financial services company. Walmart is retail, and JP Morgan is financial services. So the reason I share this with you is so you can understand the types of companies that are the largest in the world, and they really span a lot of industries, right? You've got conglomerates, you've got semiconductor, you have search engines, you've got social media, you've got car companies, you've got pharmaceutical companies, you've got retail. So it's a pretty diverse set of companies that become large in the stock market. And if you look at that $80 trillion, 40% of that, 40% of the 80 trillion is based in the US. So, a lot of the wealth in the world is based in the US. And then, you have Japan and China at 7%, Hong Kong at 6%, the United Kingdom at 4%, France at 3%, Germany, India, and Canada, and Switzerland at 2%. So that just gives you a feel for how this stock market value is distributed by country. And this is the Standard & Poor's 500. So it's 500 companies, the largest companies that Standard & Poor's have tracked for the last 90 years. So this is from 1930 to 2020. And what you need to realize is this is a log scale, which means that when you go up the y-axis, everything gets compressed. So let me just show you if it's not, this is on the regular y-axis. So basically, the y-axis is basically the value of S&P 500. But as you can see, it's hard to figure out what's going on. So it's better to use the log scale. What you see in the gray columns, every gray column, there are 15 of them in this 90-year period, are recessions. It's when the stock market went down. So remember I said that the stock market will go down? Well, it went down 15 times. But if you look at the long-term trend, in spite of it going down 14, 15 times, fairly significantly at times, the long-term trend is positive. And that's what you have to focus on if you're an investor or if you're thinking about the stock market. So history shows us that no matter how much it goes down, it always comes back, and it comes back even higher if you give it enough time. That's why I talk about long-term investing. When you talk about long-term investing, you're not worried about those short-term blips. Very important. So this was the S&P at the end of 2020, so it's about a month ago. The S&P grew 16% in 2020. That's a very, very good year. The 5-year return on the S&P is 12%, and the 10-year is 11%. So that just gives you a sense of how consistently the stock market grows, especially in recent years. You can see a very consistent growth of your broad-based index like the S&P 500, 500 different stocks, the largest stocks in the US. So I wanted to, at this time, introduce a topic called life through a bell curve. This is, I think, a very important topic that I will come back to time and again because it's a good way of looking at the world, and it's good for making decisions. So this is also called the normal distribution or Gaussian distribution. If you look at the mean, the average, which is the peak of this bell-shaped curve, that would be the average. And what we know is that within one standard deviation, one standard deviation above the mean and one standard deviation below the mean, 68% of the events will fall within one standard deviation, and 95% of events will fall within 2 standard deviations. So just keep that in mind. Just have an example here just to make it a little more real. So here's height for male and height for female. So the men are the blue histogram and the blue graph, and women are the pink histogram and the pink graph. So this basically says the average height for a man, for male, adult male, is about 70 inches. So 70 inches is about 5 feet 10 inches. And the standard deviation is 4 inches. So what does that tell you? That tells you that 68% of adult population are between 66 inches and 74 inches. And 95% of the males are between 62 inch and 78 inch. It's good to know that. For females, it's actually 65 inches is the average height, and the standard deviation is more narrow. That's why it's a taller curve and it's a narrow curve. So it's 3.5 inches. So 68% of women, adult women, are between 61.5 inches to 68.5 inches. And 95% of women between 58 and 72 inches. So, what it tells you is that it's hard to find men that are taller than 6 feet 6 inches, unless they're in the NBA. And it's hard to find women that are taller than 6 feet. So I'll come back to this, but I just wanted to introduce the concept of using a bell-shaped curve to look at a bunch of random, a set of data and using it to characterize where the population exists. So now I've applied that bell curve histogram to the S&P 500. So I took all 90 years and I put it into this histogram. So let me just explain how to read this chart. So what this basically says is that in the past 90 years, there were 3 years that the S&P went down between 25% and 39%, 3 times. So that's a lot. That's scary. And then there were 12 times that it went down between 11 and 25%. And there were 19 times where it went between 3% plus to 11% negative. And then from 3% positive to 17% positive, there was 26 times. There were 23 times that it went from 17 to 31%. There were 5 times it went from 31 to 45%. And there was 1 time it went from 45 to 59. So you can see that with these 90 data points, you create a sort of a bell-shaped curve. And if you count the number of up years and down years, you can see that in the 90 years, 62 years, the stock market went up, 28 years it went down. So that's a 70-30 split. So just realize that when you invest in the stock market, 30% of the time, you will lose money in a particular year. But just know that the average annual change over those 90 years is actually a plus 7%. So in spite of being down 30% of the time, if you look over the 90 years, you're growing at 7.6% per year over 90 years. Taking it one step further, we talked about the mean being 7.6%, and the standard deviation for this particular curve is 19%. So what that tells you is 68% of the time, you're going to either lose between 11% to making 26%, and then 95% of the time, it'll be between losing 30% to making 45%. So when I talk about decision making, you start to see that even though there are a number of years where it's negative, it's a good bet, right? Because you see the midpoint on the 68% is positive. The midpoint on the 95% is positive, and it should give you some confidence that if you invest for the long run, you'll be okay in spite of some down years. So that's a little bit about the stock market. So let's talk about compound growth. So if you are able to grow your money, let's say you have $1,000, if you are able to grow the $1,000 for 5% for 5 years, you would have $1,270. It would grow 127% in 5 years, and it will grow 162% in 10 years. So that's 5%, which is not very interesting. If you're able to get to 10%, then you're looking at 150 and 230. When you get to 15%, you're looking at doubling in 5 years and quadrupling in 10 years. That's when, for me, it gets interesting. And that's where I want to get all of you to 15%. If you can do 20%, you're talking about growing your money 2.5 times in 5 years and 6 times in 10 years. And if you grow it at 25%, you can triple your money in 5 years, and you can grow it 9 times in 10 years. So that's the kind of power in compound growth. So this is the information. So this is the information that's exact. So I rounded it off in the previous slide, but these are the exact numbers. So, and I also added the 15-year column. So you're now seeing that if you were able to grow your money 15%, it would be 8 times in 15 years. If you can grow at 20%, you're at 15 times. And if you can do 25%, you're growing at 28 times. So those are very, very powerful numbers. And that's the power of compound growth. It's just math. The key is to get the growth percent, right? So the strategy I'm going to teach you today is based on today's market conditions. It may not be the same strategy a year from now. So I don't want you to think that these are absolute strategies. These are designed for today's market conditions. And this strategy really attempts to achieve a minimum, at least 5% annual return at relatively low risk, right? So this is a beginner strategy, and it's really designed to be easy to implement. So it's easy for you to do this. It's not designed for the highest returns. We'll do that later. But now I'm just trying to get people started. So we're going to go with something that is easy to implement and it's low risk. So investing baby steps. So initially, I do not recommend buying individual stocks. Buying individual stocks has too much risk. Now, after you gain some experience, or if you're already experienced, individual stocks are fine. About 75% of my portfolio is individual stocks. So it's fine, but it's not for beginners, okay? The strategy that I'm proposing, even though it's a beginner strategy, I think it's good for experienced investors too, because it allows you to hedge your portfolio a little bit. And 25% of my own portfolio is invested exactly the way I've described. So I really recommend investing in exchange traded funds. So it's called ETFs. So here's a video from Fidelity.
What is an exchange traded fund? It's simple, really. ETFs are baskets of securities designed to provide exposure to different areas of the market. If used correctly, ETFs may be powerful tools for building solid, well-diversified portfolios. If you want exposure to the S&P 500 index, there's an ETF for that. Brazilian equities, corporate bonds, municipal bonds, commodities, yes to all. Let's look at 3 key attributes of ETFs. The first attribute is hinted at by the name, exchange-traded funds. ETFs trade throughout the day like stocks, meaning you can buy or sell them anytime the market is open. But intraday trading introduces new challenges and costs. As with stocks, you must pay a spread when you buy or sell an ETF. Unless an ETF is part of a commission-free trading program, you must pay a commission too. Be sure to pay attention to any short-term trading fees that may be incurred within a prescribed time frame when selling an ETF. And while most ETFs trade close to their net asset value, you'll want to keep an eye on less liquid ETFs to make sure you're getting a fair price too. ETFs may trade at a price that is higher premium or lower discount to their net asset value. The second attribute is cost. Let's review a few of the reasons ETFs can be a cost-efficient investment. For starters, most ETFs are index funds, which means they track the returns of a market index and are passively managed. This type of passively managed product tends to be less expensive than an actively managed product. Secondly, the ETF structure itself provides cost advantages. Record keeping, transfer agent, and other fees may be lower for ETFs than for traditional mutual funds. ETF companies may pass some of these savings along to you, the investor. Remember, though, to consider the costs of trading the ETF before you buy. Just because it has a lower headline expense ratio does not necessarily mean it's cheaper to own when you consider other costs. The third attribute is tax efficiency. One of the ways that ETFs have the potential to be tax efficient is because there are typically fewer taxable events in an ETF. For example, if you own shares of an ETF and another shareholder decides to sell some of his shares, that shareholder simply sells the shares to another investor, very similar to selling a stock. In this scenario, there would generally be no capital gains transactions for the other shareholders of the ETF. Keep in mind, the tax treatment from one ETF to another can differ, and you should always be sure to read the prospectus for specific details. One last hint when considering ETFs: be careful when selecting which ETF to buy. While many ETFs sound similar, they don't always provide the same exposure. Two different biotech ETFs, for instance, can hold very different stocks, and their annual performance can vary quite a bit. Like any investment, you have to do your research and make sure you know what you're buying. Remember, ETFs are another tool in your investing toolbox, and like any tool, the more you understand how to use them, the more effectively you can put them to work.
So just by way of summary, that ETF is a basket of stocks focused on either a sector or an index. Sector examples would be like semiconductor, biotech, information technology, or consumer services. Index examples would be the S&P 500, the Russell 2000, NASDAQ 100, and Dow Jones. I think he had mentioned that the ETFs are generally lower fees and lower cost than mutual funds. So the strategy I'm proposing reduces your risk in 5 different ways. The first is I'm asking you to only start with $1,000, so you can't lose more than $1,000. Number 2, when you invest in ETFs, it's less risky than individual stocks because your risk is now spread over a basket of stocks. I'm going to ask you to invest in different ETFs, in different sectors or different indices. So that reduces your concentration risk, right? So if one sector is going down, the other one might not be, or if one index is going down, another one might not be. So pick different sectors and different indices. Then I'm going to ask you to spread your purchase out over time so you reduce the timing risk. So I'm telling you to invest $100 every week for 10 weeks. So you're not investing all in one time frame. And then I only put low risk ETFs on the list. So if you pick from the list I give you, there are no high risk ETFs there. So I've already filtered out the ones that are riskier. So I have a list of 88 ETFs for you to choose from. These are the 88 ETFs with the highest 10-year returns. And the returns range from 13% a year to 22% a year. So that compares very favorably to the S&P, which grew 11% over 10 years. So, they range from anywhere from doing 2% to 11% better than the S&P 500. Remember I showed you that chart about 7% over 90 years? Well, these ETFs, at least historically, have done better than that. So that's why I feel very good about these particular ETFs. And they really range across a broad range of sectors and indices. And it's in the Become a Millionaire folder. So you have to send me your email and I'll get you onto that folder. I'm asking you to pick ETFs based on your long-term expectations for either that sector or that index. So if you guess correctly, you make the most money. That's what it comes down to. You're trying to look 3 to 5 years out. And if the sector index that you pick are good ones, then you'll make the most money. If you guess incorrectly, you might still make money, but you'll make less money, or you might lose money. So that's where quote unquote investing comes in. So I have an ETF selection worksheet for you to fill out, and I want you to put 10 ETFs there, and we'll cover that in a minute. And I want you to pick ETFs from at least 5 different sectors or indices. So ETFs actually are in one of these 9 quadrants. So they could have a large cap companies, like the Googles and Apples. They could be medium-sized companies, or they could be small companies. And the investing style could be growth. So you're trying to pick companies that grow rapidly, or you're looking for value, which means it's a low price to earnings ratio. So there you're getting more value for the dollar, or it's blended. So there's some value and some growth. So of those 9 cells, the light purple are the lowest risk cells, and then the purple are the medium risk. So all the 88 ETFs I'm recommending are in either the lowest risk or the medium risk cells. So here's the 88 ETFs from a large blend, large growth. So those are the columns that I just talked to you about. And they're from, the first one's actually multi-industry. So 50 of them actually go across industry. So it's not a single industry. But the other 38 are from specific industries. So there's a couple in aerospace and defense, 3 in biotechnology. You can read it too, healthcare services, pharmaceuticals, semiconductors, software programming, and technology. So those are the 88 ETFs I've selected for you. And here's the first 44. It's a little hard to read, so I'm going to blow it up. So I'm just going to talk about a couple of them. So the first is actually one of my favorites. It's SOXX. It's an ETF that tracks the semiconductor industry. Over 10 years, it's done 22%. The last 5 years, it's done 35% a year. And the last 3 years, it's done 32%. So that's a very good ETF. There's actually another 3 semiconductor ones in the top 5. So I would only pick one of them. Don't pick more than one. Number 3, XBI, is a biotech ETF, and that's done 21% over the last 10 years, 15 in the last 5, and 18 in the last 3. So, and then number 6 is PNQI. That's a NASDAQ index. Number 7 is VGT, which is Vanguard Information Technology. That's a good one. Anyway, so this is the list. This is the second 44 from 45 to 88, and this is in the folder for you to look at. So how do you research these ETFs? So you would actually enter it into the red box there. You enter the name, the symbol, the SOXX, and then you'll get a little chart. And there's different links where you look at, it's detailed quote. You can look at the performance. You can look at, the portfolio composition. So what stocks are in this ETF? And as you can see, the graph of stocks, there was a big dip in March. That was when COVID first hit and everything got shut down. And you can see it's now bounced back, and it's doing very well. So that's just an example of stocks. This is the ETF selection worksheet I want you to work through. So for each one that you pick, I want you to put the symbol, the name or the description of the ETF, the reason that you've selected this one over the other ones, and then put a confidence level, 1 to 10, 10 being the most confident, 1 being you're not confident. So pick out 10 of them. Try to pick them from different sectors, different industries, different indexes. And after you've done that, then the ones that are 10, you should, you need to sort them. So the A would be your highest confidence, B would be your second highest confidence, C, D, and E, so on and so forth. If you have 2 10s, then make one A and the other one B. So after you do that, what I want you to do is, with the $1,000 in your Become a Millionaire brokerage account, I want you to invest $100 in A in week 1. So that's this week. So after you've filled out your worksheet, invest $100 in A. And then next week, invest $100 in B, so on and so forth. And do that for 5 weeks. By week 5, you have invested in 5 different ETFs. Some will have gone up, some will have gone down, some will go up and down. I mean, you will start to get a feel for what these ETFs do. After 5 weeks, I want you to fill out a new worksheet, because now you've learned something, right? You've learned whether your reasons were right, your confidence is right. Fill out a new sheet and pick 5 again. And compare your worksheet from week 5 to your worksheet from week 0, the first one you do. And you start to get a better feel for what were good choices you made, what were not so good choices, and you start to refine your thinking. So this process I'm teaching you is something that I went through to learn about ETFs, to learn about how I picked them, whether I did good things, I did bad things, and the things that you thought were good, you do more of. The ones where you made mistakes, then do less of. So over time, every week, you'll get a little smarter, you'll get a little bit more information about these things. And I think every 5 weeks, you should redo this process in order to get a better feel for the market. So from weeks 6 through 10, you'll keep investing $100 a week. And you can add more to the ones you like. You can pick a different 5. It's up, week 6, 10 is up to you based on what you learned in week 1 through 5. And then by week 10, you have invested $1,000. You'll have diversified ETFs, you'll have sector diversification, and you'll have time diversification. So just remember, this strategy relies on trades being free. So if your brokerage does not offer free trades, don't use it. Go to Fidelity. Most of them offer free trades now. You cannot pay money for this. When there's $100, you're paying $2, $3 for a trade, you'll lose all your money on trading commission. So make sure whatever brokerage you sign up with, it's completely free trades. So week 10 ends April 9th. So my 4th session, which will be April, the first Tuesday in April, I will tell you what to do from week 11 and beyond. But that gives you enough information to do the first 10 weeks. So I've also opened BAM account, and I'm going to fill out that worksheet. And I'm going to invest alongside with you, and I will show you how I do in April, and you can show me how you do. So this will be something we will talk from month to month, just to get a feel for how everyone is doing, and if they have questions, if it's working, it's not working, what you've learned. So to me, this is as much about learning about the investing process as it is about investing. So how do you invest? How do you invest $100? So actually, this is my BAM account. There's $1,000 there, and I'll talk you through it. So you go up to stocks. So you hit trade, and then this window pops down. I'll put in stocks, and it comes up and tells you what the price is. And because I'm doing partial shares, you have to click a button to get to this screen where you can do dollars instead of shares. Because $400, you're going to buy 25% shares. So you put $100 there. You should probably just do market. I did a limit here. We'll talk about that later session. Just do market, and then you preview the order. You're going to buy, you preview the order. So you see the commission is 0. That's very important. So I decide that I want to change the limit price. Preview the order. Is that what you want? You get a chance to look at it. If it's not right, there's actually a button for me to edit the order. So I decide to edit the order, make it 400. Preview the order, and then you place the order. That's it. So that's how you buy $100 of a $400 stock. So I wanted to emphasize the value of learning to invest. So assuming you can get 10% annual return, if you had only $1,000, that work would earn you $100 because that's 10% of 1,000. If you had $100,000 and you could earn 10%, you've earned $10,000. It's the same skill, same amount of time, and you either make $100 or you make $10,000, depending on how much money you have to invest. So I always think it's best to learn when you have limited funds, because that's when you're not losing a lot of money, and so that by the time you do save or have accumulated $50,000 to $100,000, you're getting 10 to 15%. So this is the perfect time to learn this skill. It should not take too long. I think in a few months you'll be comfortable getting 5 or 10%, and over time we'll get that up to 15 to 20%. So let's now add annual savings into this. We talked about compound growth, we talked about annual return, and now we're going to talk about annual savings. So if you invest $10,000 today at 25%, and we talked about this before, so this is just compound growth. You get $30,000 in 5 years, you get $90,000 in 10 years. But if you also invest an additional $10,000 each year, so now you're not just investing $10,000 once, but you're investing $10,000 year 1, year 2, year 3, year 4, year 5. If you do that, you won't have $30,000, you'll have $100,000. If you do that for 10 years, now you have $400,000. That's 40 times the $10,000 if you were to do that for 10 years. So that's what I mean about combining these three secrets: compound growth, annual returns, and annual savings to work together. And that's how you'll become a millionaire. If you can get these three things to work together and you can grow, you can get $400,000 in 10 years, you'll easily get to $1 million. So again, here's the more exact numbers. Not the numbers that I made kind of even. So just as an example, I also added year 15. So if you invested $10,000 a year for 15 years, and you were able to get 15% annual return, you would have $557,000 by year 15. If you could get to 20%, you could have $800,000, $870,000. If you can get to 25%, you have $1.3 million in just 15 years. So that's where we're all trying to get to. This is where it all comes together. So you need to memorize this chart, right? So the $10,000 can become $30,000 in 5 years or $90,000 in 10 years. And if you do $10,000 a year, it becomes $100,000 in 5 years or $400,000 in 10 years. This chart should just be like your math tables, like 2 times 2 equals 4, 10K for 10 years, $400,000. You need to have that in your head so that so you can remember it. It's very important. So on to the next section, which is cut expense by 5%. So cutting expense is really a frame of mind. It's something, this age-old adage that goes, if you take care of the pennies, the dollars will take care of themselves. And that's true then and it's true today. But I have to adapt it for today because of inflation. So if you take care of the dollars, a dollar here, a dollar there, but thousands will take care of themselves. And I think it's dangerous to say, oh, it's just a couple of dollars, who cares? It doesn't matter. Well, it all adds up. It does matter. And you're cutting expenses in order to put it into your BAM account, right? So when I'm talking about, $10,000 becoming $400,000, well, you have to cut your expenses so you can save that $10,000 a year. Remember, what you're trying to save is a percentage of your annual income. And so at this point, you should go through the list that you created as your homework in session 1. that you identified all the expenses. Now you should be going through it and seeing which ones you can either reduce or eliminate. So if you go through that exercise, it shouldn't take you more than like maybe an hour to go through that and see what you can cut. If you can cut nothing, you're not trying hard enough. You have to work a little harder. If you're 1 to 4%, that's actually a pretty good start. So hopefully you can do that. If you can get to 5 to 9%, you're already beyond the basic level. If you can get to 10 to 14%, you're doing very well. 15 to 20% is excellent, and 21 to 25 is you're a genius. So you need to do that exercise before the next session. And I'm actually at this point recommending that you find someone else in this group. You're one of the other members. Just do it through the messaging. But find someone that can be your buddy, someone who's actually gone through the same sessions, and you can mutually go through each other's expense cuts and, be a sounding board, provide ideas, see what the other person is doing. Can you do the same thing? But having someone to work with, I think, will make this exercise more successful. And I'm hoping that all of you can save at least 5% of your income by cutting expenses. I don't know that you can, but if you can, I think that's an important first step. And if you do that, you need to take that 5% that you saved and do an auto deposit into your BAM account. So every month, it's like a bill, that 5% of your income gets put into your BAM account so that you can begin to grow that. And I want you to do this before session 3. So treat this as homework for session 2. So here's an example. So let's assume you make $50,000 a year. A 5% cut would be about $2,500 per year. That's 5% of the $50,000. And if you divide that by 12 months, it's about $200 a month. So the question is, can you cut $200 a month to put into your BAM account? Can you save $200 a month? If you can do it, then you need to do it immediately and set that up as an automatic deposit. That would be step 1 in becoming a millionaire. So that completes the content for today. So let's talk about what we've done. So we did session 1, which was basically the January session of augment, cut, and expand. Session 2 today was about expanding wealth. I talked about the baby steps to get started, investing $100 a week for 10 weeks. Talked about cutting your expense by 5% and putting that into your BAM account. And then next month, I'm going to talk about augmenting your income by 5%. That'll be the March session. And then for the rest of the year, we'll have more augment income sessions. There'll be another cut expense session, 2 more expand wealth modules, 1 on purchase home, 2 on developing your project plan, and 1 on continuous improvement. So that's the rest of the year. And here's the homework for session 2. So the first is just send me your email so I can put you on the Become a Millionaire folder. Find your Become a Millionaire buddy so that you can work with them to cut your expense. Using your BAM Composite score in that, what's going on here? Someone chatting? Oh, people are giving me the emails. Okay, I'll do that later. Actually, would you mind putting it in the meetup? Because when I close the session, I'm going to lose those emails. So the chat doesn't work too well. So use that spreadsheet to build your network forecast tool. Do the expand wealth 5% exercise. Select the 10 ETFs. Invest $100 a week for 10 weeks. And then at 4 o'clock, that's when the stock market closes, you'll look at your account for a couple of minutes. That's all you need. Just look at the 3 or 4. In the beginning, it's only 1. Just look at what it does for 5 days, and then next week you'll have 2. Look at what that does. Just take a couple of minutes. It just starts to give you a feel for the market and your ETFs, and then be ready to talk about it by the next session, because I want to get some feedback about how you're feeling about it. And then in terms of cut expense, identify the expenses you can reduce or eliminate. Go over with your BAM buddy. Tell me how much you can cut per month. What percentage of your income is that? And then set up your automatic deposit to your BAM account. And then the next thing I want you to do is put together some goals for the rest of this year. So whatever your initial BAM Composite score is, let's say it was 0%, what do you want to be at the end of Q1? That's end of March. What do you want to be at the end of June, end of September, end of December? So see what you can do there. Just put some targets down. And I think that's it. What did you learn today? I'm sorry, I got a little summary. So what did you learn today? You learned about the long-term versus short-term teaching and how I'm doing a blended approach. You learned about the ladder to success. You have to do those 4 steps before you can have achieved that particular 5% in expand wealth. You learned about the stock market. You learned about how the S&P has grown over the years. You've learned how to expand wealth by at least 5%. You learned how combining compound growth with annual returns and baby steps and saving money every year, doing all 3 of them together can grow your wealth rapidly. And you learned how to cut expense and work with your BAM buddy. So you're picking 10 ETFs, $100 a week, and to improve your decision-making. That's what that sheet is about, so that you can begin to think about how you think about these ETFs and to refine your thinking process. I think that's it. That is the end of the content I have for today. That was 1 hour and 7 minutes, not bad. And I will now open it up for feedback, comments, questions, and feel free to unmute yourself. We have 19 people. That's very nice. Let me.
Hi, Phil. It's Fiona. Can I ask a question?
Of course.
So, well, first of all, I want to say thank you again. You somehow make this very easy to understand for someone who doesn't find it easy. So I really appreciate you for that. Thank you. And with regards to the $100 a week, is it important to do that on the same day and time each week? And if so, is there a preferred day and time?
No. It's not important to do it the same day or time. Just do 100 a week. So in the future lesson, I will probably talk about trying to buy it on a dip, but that's probably too advanced for initial session. So I would just say, just buy it any day. It's really not that important because it's random, right? The 5 days will all be different, and that doesn't matter.
Okay.
Does not matter.
Thank you.
You're welcome. Hey, Victor, did you want to talk? You're unmuted.
I am muted. Just want to say
Yes.
thank you. Really good information. And I guess it is low risk, and we just do it, right? Just do it.
Just do it. It's not no risk. It's low risk.
Low risk, exactly. But
I want to make that very clear. It's not no risk. I mean,
But I like the just the baby steps, like you said, hand holding and getting ourselves to do it. Because if you didn't ask for the exercises and the homework, probably won't do it. But I say, okay, sure, and then don't do it.
No, remember the first session, I said that you got to work hard. If you're not going to do the exercises and you just come to this, you're just not going to benefit. So
Right.
it's okay. Some people won't do it. Remember I talked about bell-shaped curve? There will be people that are like A students. They'll do everything I say and they'll do well. There'll be some people who do nothing. And I expect that. That's just life. And then 2/3 of the people will be in the middle and they'll do it. So it's fine. I mean, it's a random process. It's a random population. So I hope everyone does it. I really hope everyone does it, but I don't think that's not real life, right? You'll get some people who are very diligent and you'll get others who are less so, and that's okay.
Yeah. And that being low risk it's kind of like see what happens, right? See what happens.
So I was going to save this for a later session, but remember I said that this strategy will get you at least 5% a year. At least is the key word. I mean,
Right.
Using that strategy, I did about 40% last year. Using that strategy, I've done 2% in January. In just January, 2%. That's 24% a year. So it's a pretty solid strategy. It's not perfect. I mean, it depends on the market. The market's been pretty bullish the last few years. So, if that changes, then obviously things will change. But who knows? I mean, we can't tell the future. But what I shared with you is a really good strategy. I designed that myself. So I did not learn that from anybody. That's what I've learned through trial and error. And it took me a while to get to that. I used to use mutual funds. And every year I would lose like 1% of them. And I was like, what's that about? ETFs, the fees are so low. It's like 0.2% or 0.3%. Whereas mutual funds are like 1.25%, 1.5%. So their active management isn't worth it. So I've refined this. And again, this would not work last year because I used to pay $8 a trade. You can't pay $8 a trade on a $100 trade. You can't do it. So this works today because of the way the brokerages have changed. About 9 months ago, I can't remember who it was. One company said, I'm doing free trades. And within 2 weeks, they were all doing free trades. So now we can do this. We can learn. Otherwise, you wouldn't be able to learn this way. You would have to do what we call paper trades. You just fake it. You say, I'm going to act like I bought it, and then but that doesn't have the same feeling. You want to be real. So even though it's not a lot of money, it's real. It's real money, and you're doing something real, and you're getting. It's really learned by doing. I mean, I find that for me, that's the best way to learn. When you learn in a textbook and you don't really. Anyways.
Mm-hmm, mm-hmm.
Thank you, Victor.
Yeah.
Hi, Phil.
Hey, Lynn.
Hi, this is a really informative session, and I'm excited to get started on it. So when we choose our ETFs, are we looking that we're probably going to commit to that ETF 3 to 5 years? I mean, I know at the beginning we're kind of learning, but
you know, that's the way you should think about it, but you don't have to.
okay.
Because obviously you're trying to make a long-term decision.
Okay.
You're not trying to make a decision that's going to be good in a month. You're trying to make a 3 to 5 year decision.
Okay.
Now, if after, let's say 3 months, you realize you picked a real bad ETF, yeah, get rid of it. I mean, I'm not saying you have to keep it for 3 to 5 years. It's just the way you think about it.
Okay.
Right? It's the way you approach selecting. You're selecting for the long run. So.
Are there any tools you recommend for researching each ETF to look at its history? I mean, other than, I guess, just you look at the chart or?
There are a lot of tools out there. I mean, usually I just look at I just go to Fidelity, type in the symbol, and just take a look at that and click the links. Now, there are some analyst reports. So I mean, Fidelity, as an example, probably has like 10 or 12 companies who write about these companies, and there are links, and you click it, and there's like a 2 or 3 page thing, and you can read about it. So I'm not actually thinking that you shouldn't worry too much about studying in a great deal of detail for now, because that's too much work. You can't study 88. In fact, unless you really feel compelled, I wouldn't even go to page 2. I mean, you can find 5 in the top 44. You should stick to that. Only if you can't find what you like, then go to the next 44. But honest to God, I mean, within the top 20, you should be able to find 5. And I would, at the first pass, you should just pick industries you like. I mean, if you like healthcare, That's healthcare. You like semiconductor, you like software, you like IT. Do it at a macro level. I mean, when you start clicking the links, you're going to get brain freeze. I mean, there's way too much information there. I mean, do it for fun, but you're really just buying the sector. You're buying the index. You like S&P, buy S&P. You don't have to go crazy about it. And right in your reason, just say, I think that the Standard & Poor's 500, five largest, that's a good bet. That's all I'm asking you to do. I'm not asking you to because that's too much work. I just want you to look at the names, look at the 3-year, 10-year, 5-year return, and say, I like this one because I like semiconductors. I think that computers and semiconductor chips are going to be growing over the next 5 years. Or just say, hey, this one is number one over the last 10 years. I'm picking number one. You don't need to go crazy on the reason, but have a reason. Don't have no reason. Just come up with a fairly lucid reason. Yeah, I don't want you. So in terms of picking these 10, I would not spend more than a couple hours. You shouldn't need to. I mean, you don't go crazy. This is not about going crazy. These are pre-selected, remember. I mean, I'm not giving you things that you have to then go research again, right? All 88 are good, right? I mean, they're the top 88 ETFs in the last 10 years. So, all the ones that, there's another 300 that didn't make the list, right? Those are gone. Those high risk ones are gone. So there aren't many that you'll go wrong with, but I don't want to tell you what to do. So I want you to pick. But if you stick with the first 20 or 30, I don't think you'll go wrong.
You're saying just basically keep it
different sectors. Don't pick 5 in semiconductor.
Right. Keep it diverse in terms of the sectors. Okay. Thank you, Phil.
You're welcome. Anyone else?
Okay, Phil, Lisa. So I think, basically to me, this is kind of like trying to control skydiving if you've never done it before, which is exciting to me because I don't take a lot of risks in my life. So I just think that how I'm looking at the list that you gave us, since I really don't know a lot about things, I would tend to pick different things to see how they play out, to see what it means. If I pick all the same, to me, that would be a little boring. So I think what you're trying to, at least what I'm getting from this is, yes, try and be a little sure-footed maybe on something, but then go completely the other way for something you really don't know anything about to see what it teaches you. So I think that's what I'm going to try to do as far as this is kind of be like, okay, here, and then let me see what this takes me and maybe be completely surprised kind of a thing. It's going to be a complete surprise to me and probably a good percentage of us that have never done this before. So I just find it's kind of exciting, because it is the road that I have never traveled. So, but yeah, that's kind of the approach I think I'm going to take for myself.
I think that's a good approach. That's a good approach. But remember, after 5 weeks, you're going to do it again. And you're going to, and you'll do it differently. Hopefully you'll learn something and you'll do it differently next time. So it's okay that the first time isn't right. Remember, baby steps, it's okay to fall, right? It's okay. It's $100. You're not going to, and you're not going to lose it all. If let's say you lost 10%, you lose $10. That's less than a lunch. So that's what, it's okay to do it wrong. We're doing this in a way that's safe, right? You can fall and it's okay. Thank you, Lisa.
Yeah, I just think it's funny because some of these names, because I work for Crown Castle, so we provide.
You work for Crown Castle? Yeah. I just bought their stock.
Yeah, well, I contract. That's on my list to get hired. I've been a contractor they had a hiring freeze.
Yep.
So,
well, whether you're a contractor or employee, you work for them.
Right, exactly. So a lot of these names I see come up for, inquiries about their accounts and things. So I'm kind of chuckling.
Interesting.
That they're a little familiar to me. But yeah, Crown Castle seems to be doing okay, so we'll keep our fingers crossed. That will keep Lisa working. But yeah, thank you very much. Very good, very informative. A lot of information, which is good.
Hey, Marley.
Hi.
You on mute?
Good. Yeah, it was a good session. It was very informative. I learned a lot of new things, and it seems like a fun project to take on. I just have one question about the Fidelity account. See, since I'm from Canada, can I still open an account? Like, how does it work? I'm not really sure.
I'm actually not familiar with investing outside the U.S. Does anyone know? I assume Fidelity has offices in Toronto. Do they not? I don't know. I don't know. I couldn't help you. I don't know the answer to that question. Does anyone else have international experience? I've never, are there Canadian-based brokerage firms? I'll tell you what, Marley, I'll do a little research and I'll text you. I think Fidelity can do it, but I don't want to say that until I've checked.
Okay.
It's a quick check.
Okay. All right. Thank you.
And not even that, but what about the tax savings? What kind of tax savings are there in Canada?
I don't know the Canadian tax laws either. So unfortunately, Marley, I will be talking mostly about U.S. tax laws. Because that's what I know. I'm sorry. I think it's, I'll try to do a little Canadian research. I assume it's similar, but I'll do a little research. But most of my information is based on my experience was in the U.S. So I apologize. I may not be the best. I may not be the expert for Canadian tax laws, but we haven't done that yet. So when I do the home buying session, I'll brush up on my Canadian tax laws for mortgage deduction.
That's what Marley wants to do in the future, buying the home, right?
That's very important. That's very important.
Okay. Thank you.
You're welcome. Anybody else? Well, if there's nothing else, I want to thank all of you for coming to the session 2, a preview on session 3. So session 3, I'm going to talk about being CEO of your job. So how do you get a big fat raise? I'm going to teach you all the secrets of getting the biggest raise you ever got in your life. So that's the next session. So that's the
for, right? Phil, you just ask for it.
You do ask for it, but you have to do something before that. Before you ask for it, you have to be valuable. You make yourself valuable, then you ask for it. But I can't do a 1-hour session in 30 seconds. This is just a teaser. I'm very excited about this because this is what my book is about. So half of my book is about being CEO of your job and how do you get a big fat raise. And I'm telling you, it works because I'm the one that used to give those raises. I knew which things made me give the raise, and I knew which things I said no to. So I've been there. So I'm going to share that with you all next month, and I'm really looking forward to it. Mary, did you want to say something, Mary? You have to unmute first, Mary. Mary, unmute.
I just want to applause.
Oh, thank you. Thank you very much. Thank you for coming. It, this group has really energized me. I mean, this is a lot of fun. I'm probably having more fun than you guys, but that's okay. That's my reward. So thank you everyone for coming, and we'll see you next month. And I'll post this on YouTube so that if anyone wants to get a refresher or if someone missed the session, they can go see that. Bye.
Okay. Bye.
Bye, Phil.
Bye-bye.
Thank you.
How do you shut this?
Good.
I don't know how to shut this.
Goodbye.
Bye.